in order to understand this working capital management issue, you need to remember one thing, that when we talk about working capital, we need to know what we talk about. And this is a question, because as many people there are, as many ideas about what working capital is. Because financial managers tend to rely very heavily on financial statements. And when you look in the financial statement, there's nothing like working capital. This is like one position to understand this. Another position to understand this is that if you manage a company, you have a lot of different sorrows or a lot of different aims or targets. Naturally, the target number one would be to have a tangible profit at the end of the day. This is as simple as it could be, just to be a profitable company. But then another issue is that even if you have an idea, even if you have a place, even if you have a market, even if you have people to do this, even if you have something very innovative, if you have just the greatest idea of all times, if you don't have money to do it, no way you could achieve it. So this is the fundamental thought behind the working capital idea, is that you need to have money. And then the question is how to operate with the money. I mean, how much I should have, or when I should have, or for what I should have, or is it wise to have as much as possible? Maybe it's not so wise. So how much should I have? Plenty of questions, and this is a very confusing subject in many books, because many authors describe the same problem from different angles, or from different perspectives, or with different formulas, or with different ideas. So when you have that, naturally you may become confused. So my first personal advice from the professor with some experience is don't be scary of working capital. Even if you read in different books that some people think it's a different thing or they advise differently, it is how it is. It's like I told you at the beginning that economics and finance, it's not a very proper science as, say, physics or chemistry. It's as well not so free as art, but it's somewhere in between, like medicine. In generally there are ideas, but when somebody makes an operation, at least 3 or 4 possibilities how to do it. Some people will do it like this, some like that. So the same applies to the working capital issue. So now we will see what's our aim. Our aim actually is to underline this importance of working capital to any business. And because it's such a large issue, there are many different ways of approaching this question. And already when we have these different ways in mind, then we have to define what is this working capital. I mean, if we make a definition or a formula, it would be nice. Of course, it's probably one of many definitions and one of many formulas, but it would be nice to have at least one. And when we have this working capital formula or definition, then we could think what is the key component of that. And then, if you already know what it is, then we could think, okay, and now what tools or what approaches we need in order to get this working capital. In other words, what are the requirements? And if already we know what it is, and if we know, say, how much or how, then at the end, there are some policies of this management of this capital and control. And if we touch the element of control, inevitably there will be some formulas, some ratios, some mathematics in that. So this is how we approach this. In order to approach this really carefully, we need to step again into the question of costs. Because when we talk about the working capital, we think really behind our heads it's about costs. Because, as I said, we talk about the working capital, in a sense, it's money that we need to have in order to do properly our business. And if so, then the costs are inevitable element of the whole concept and thinking. And to make the approach step by step, we have to underline or to define that there are single product businesses, and this is like in theory almost never happening. Never happening in practice, but in theory it's nice because it allows us to calculate, to make the calculations examples easier. Means single product business would be, say, a person standing on the edge of the beach and having just one kind of ice cream and selling this ice cream like in one in one particular size, and assuming this person is producing this ice cream as well. It's like homemade ice cream. So then the output consists of identical items because it's like 2 scoops or of ice cream always. And if you produce something on a very large scale, but it's only one single product, as well, this applies to this way of thinking. But naturally, majority of the businesses are multi-product businesses. And then when it's this multi-product business, then we have to find a concept, like this job costing concept. What it is, again, we will explain this in a certain way. That if we have a cost that is fixed cost for the whole business, and when we do very different outcomes, productions, whatever products, then we have to find a solution how to like spread this fixed cost of our business on all items that we produce, which is of course not easy, but it's one of the fundamental concepts of the science that is called management accountancy. And in order really to get how we spread every cost that we incur in our business, we need to find a proper understanding what is direct and what is indirect cost. And we have to stop just for a moment here, because the explanation is easy, but you have to grasp it. Direct cost, a cost that could be identified with specific cost units. And direct cost could be traced to a particular cost unit and it can be measured reliably. What it means in like different language is that, Direct cost is this cost that you could point with the finger. It lands in such a dimension in this product. Like, I try to find the example. Let's say this is a gentleman that produces these ice creams, and he has like two varieties, like vanilla ice cream and chocolate ice cream. So when he buys chocolate and he puts this chocolate into production, he can point, this chocolate ends up in my chocolate ice cream. So it's direct. It doesn't go to vanilla ice cream. No way. It goes there. However, much more complicated, the question is in case of indirect costs, which are overheads. It's called like overheads, like over the business overheads. And these indirect costs are much more complicated because they cannot be identified with each particular cost unit. Like, for example, just have this very small example of this gentleman making ice cream. I mean, his personal insurance for this production. How could we, like, put a finger how much of this insurance is in vanilla ice cream and how much is in a chocolate ice cream? No way. I mean, there are ways, but like different approaches and different calculations. But directly, you could not know. So this indirect cost, like overheads, they could not be identified with each particular unit, right? So the overheads are charged, or there is a proper word, allocation. So they are allocated to each cost unit with appropriate rate. Nice. And then you say, now the professor made us completely confused because we have fixed and variable and direct and indirect. What the heck is about that? So this table makes an attempt to describe this somehow. So we could, as you could see on this table, you could have all possible combinations. But let's say, I suppose the most common would be fixed and indirect. And for example, this building, office building that we have in our factory, this cost of operation of this building or rent is of course fixed because we rent it no matter what we produce, but as well as indirect because we cannot link directly the cost of the renting of the building with the item of production. As well, variable and direct are quite intuitive because it seems natural that, for example, the cost of raw material or labor that goes into 1 unit of output, it is variable because it depends on the scale of production, and as well direct because we could, in many occasions, quite easily trace this cost into the unit. So it's fairly natural. But as well, it might happen that fixed would be direct. If for some reason there is a building that we rent, and in this building we produce always and only the same production, most likely we would appropriate directly. However, it's a fixed cost. As well, variable and indirect might happen. The example described here is advertising, that for logic reason with the scale of production it would as well increase. So from this point of view it's sort of variable if we could really make the proper calculation. But as being advertising for everything that we have in our company, it's indirect, unless for some reason we could trace it to a product. You could see it's quite a complex approach. So let's make some calculation. We have an example with a factory that produces a single product within the following budget costs. There's direct materials of £4.5 per unit, direct labor 7.85, variable overheads that are linked with this unit is 1.6, and fixed overheads in our factory are 420,000. So now there is a question how really to calculate the cost of our product. And we have a very valuable information that overheads, this sort of overall costs, are absorbed on the machine hour basis. Yeah, there are different ways of making this absorption, and one of the most common is hour of labor or hour of machinery. So on the machine hour basis, it is estimated that this machine hours in total will make 105,000 hours. And additional information, without which we cannot make a proper calculation, is that each unit of our production requires 2.5 hours of machine time. So now how could we make the calculation? It's not a rocket science. I suppose some people already instinctively know how to do it. And I would normally ask you to calculate, but you have it on the next page. So because you have it, I will show this calculation. So the solution is like that. Direct material plus direct labor plus variable overheads, it all totals 13.95. And now, this famous word absorption. How the absorption goes? Absorption of the fixed overheads goes as follows. Per hour of production, because we divide it per hour. So 420 divided by 105,000 in both cases means 4. And if it's 4, and then you could see here it's 2.5 hours per each unit. So we multiply this 4 by 2.5, and we arrive to the number of 10. Therefore, this cost per unit is all at the beginning. This 13.95 plus 10 means £23.95. And then there is a question, another example, looks like this. Because these overheads should be charged on each cost of a unit. But we have the situation like that. We have 2 jobs in our company. And one job requires 100 workers, and it takes 5 days to complete. And then we have the job B with 100 workers, but it needs 25 days. Now, we have 30,000 rent in overheads to be charged for the building on these 2 jobs. I mean, this example is very simplified, but just to give you a feeling how it is done. So the question is it fair to charge £15,000 on each job? Of course, normally again, I would ask you to calculate because it's pre-recorded. We will see how it looks. So we have to determine the basis. Determine the basis is very important because on what? On direct labor hour, direct machine hour, the volume of output. So, secondly, as well, we have to establish this overhead absorption rate. So we have to make some assumptions that every worker works 8 hours and total is always 100, overhead is 30,000, and total days of both projects is 5 plus 25, means 30. If so, we make this following calculation. The overhead absorption rate would be 30,000 divided by 30 days of 100 workers working 8 hours per day. So it means that if we do it on this hour of labor, it would be £1.25. And now we calculate how we should divide this overheads. So by the job, so we take the job A, which is 125 per hour, 8 hours per day. There are 5 days per 100 workers, means 5,000. And overheads for the job B will be calculated in a very similar way, that it's 1.25 multiplied by 8 hours a day, multiplied by 25 days, and multiplied by 100 workers, means 25,000 in total. And this is a fair absorption in case of these two jobs. And a concluding remark, that there is no one single always correct way of allocating overheads. They could not be directly traced back to cost units, so all the allocations are estimations, but one could be more accurate than others. It means, you have to decide as manager how you would calculate this absorption of these so-called overheads. There is no single, always correct manner. Now, we come to really the managing of the working capital. And listen, it's very important to have a grasp of that within companies, they are very often quite adverse or competitive ideas of how the business should be run and what is important. Yeah, it's like comparing to football. Some of them who are strikers would say, okay, no matter how many goals we lose, it's important how many goals we score. And then a goalkeeper would say, no, the most important is not to lose goals, and hopefully we will score goals. So it's like different concept. So we have this operational and financial perspective. And for example, manager from the operational perspective, he would like to have always stock, quite plenty of stock, because then he is secure. He always could do the menu in the restaurant, and he would always satisfy the customer's desires. But from the financial perspective, like the accountant or the financial manager, he would say, no, we want to keep the inventory to the minimum because it's our money, and less inventory we have, less money we need to run the business. And as well, for example, this manager that he would like organize something like a big event might agree on credit terms with the customer, which would be beneficial for the customer because it eases his particular need for money. But then the accountant or the financial manager would say, come on, so it means we cover this with money, and as well, is this customer creditworthy? I mean, will he pay? And there is always a question if he pays the whole amount, or in what time, or without delay, many things. When it's on credit, it's on credit. So many things could happen. Again, from the operational perspective, like this manager on operations, he would like to have very good relations with the suppliers because he would like to be flexible with them and be sure that they always could sell to him. But then, from the point of view of the financial manager, as late as we pay to the suppliers, this is the best for us. I mean, if it's very long period of payment, it's even fantastic for us. We will just show it in a moment, hopefully. So then it's a different perspective. And then, one wants to maximize sort of the return on assets and make the volume as big as possible. The other one wants just to keep the risk as low as possible. And how it looks like in the cycle it's designed here. We could start here. At that given point, we have the revenue from our customers. Then we buy some raw materials, so it's our inventory. Then, on the other hand, we have this trade receivables that we receive from our customers. And another item is that we pay money to sellers. So it's like the whole cycle here that we buy inventory, we pay, we produce, we sell the product, then we receive the money, then it goes again to buy the stock. So it's like this working capital is a concept that the money in our business always goes around and for certain purposes. Either it's invested in raw materials from the suppliers, or it's in the production, or it's in stock with finished items, plenty of things. There's a short reminder of definitions. What is cost of goods sold? So cost of goods sold refers to direct costs of producing the goods sold later by the company. So this amount in principle includes everything that is directly into the product, like the raw materials and labor. However, it does not have all these sort of indirect expenses and other things related to our business as it's in a whole. Then overheads are all the other important things in the business, like ongoing business expenses. And as we know, it's very hard to attribute this to a particular product or service. So it's very important that we could budget this and we could determine how, on what principle it will be absorbed by certain points of absorption in our business. So overall, it means that overheads are any expenses that are incurred in order to run the business, but they are not directly related to any of our products or services. There is a small table with a company here that we have. It's written what the company sells, what are the costs of goods sold, wages, electricity, depreciation, other overheads, total expenses, and then the net profit, month by month. It's on monthly basis. So, how we measure this? So, this working capital or operating working capital, this is just so many definitions. Generally, it's current assets minus current liabilities. When we take the financial statement, it's current assets minus current liabilities. There are some important points in that. In a moment we will talk about that. So, yes, this is the money expected to flow in, flow out. It's like operating working capital. And as well here it's again underlined the objectives of this working capital, like minimize the risk of insolvency, running out of cash, but as well maximizing the return on assets, like be very efficient with the money that we have. And from different perspectives, again, the investment decision is what do I need to buy, and financial decision, where can I access the money for it, if it's from the point of view of the policy of the company. Now, there's a very brief review of this financial accounting that we have, because we will, of course, calculate several ratios. So when we have this this big equation, this fundamental equation for financial accounting, assets equal liabilities plus equity. Equity is our own money, basically. Yes, that's what we put into the company, and the company worked or earned and kept return earnings. So we do not talk about that. We have assets and liabilities, and we have current and non-current. And for our operating working capital, we take into account only current assets and current liabilities. Now, a very short word about policy, or like matching policy. So, in principle, there is a thinking that if we do any business, we have a situation, then we have non-current assets, all these fixed assets that we have like for long time. No matter what happens, we need to have them in our company. Then we have some kind of current assets that are like on permanent basis. We know that they are current, but we know that we will always have them, or nearly always. And then we have these sort of fluctuating current assets, really related very closely with the nature of our business. So the matching policy in principle is to have a long-term financing for non-current assets and permanent current assets, and short-term financing, any loans or something like this, many other things, that we will have for fluctuating current assets. And this is like this sort of normal policy. But we as well could have conservative policy. Conservative policy means we are not taking too many risks. So what we do, with long-term financing that we have, we cover non-current assets and permanent current assets, as well a portion of fluctuating current assets. By the way, this graph very often is designed in a way that it grows. So this wave is going up, because as a matter of sense, then when it's with time, we should expect the growth of our company. So all that should be bigger and bigger, right? And it should be on upward slope. So this is conservative policy, very stable, no risk. But of course, we might have an aggressive policy when part of permanent current assets is actually financed by short-term financing. And then, because then this short-term financing covers both fluctuating current assets and permanent current assets. Of course, I mean, if you run your business, you might be always on short-term financing with everything, but it's extremely risky. Or if you are very conservative, you could cover everything with long-term financing. Of course, but these examples with conservative and aggressive policy make you aware with how it looks like. And when we talk about different businesses, it's very important to know that different businesses have different requirements. And these requirements come from different points of interest or view, like holding inventory, time allowed for customers to pay, time taken to pay suppliers. It's very important because there are businesses that need a very large inventory and businesses with no inventory whatsoever, almost, right? And then as well, some businesses you are allowed to pay a long time, in others not. So there's like this working capital management questions. But then you think about longer issues in your company. Maybe you should rebrand, or maybe you should renovate in case of hotel, or maybe refunction instead of, I don't know, a restaurant, lunch restaurant, maybe you should refunction this to a nightclub. Depends. So these are like asset management decisions more than working capital management. But, this working capital, I return to this point, is about like money now in the company, not to lose liquidity and to be always in a position of solvency. This is the question of this working capital.